Good afternoon. We are Tecnológico de Monterrey Campus Ciudad de México, and today we present our buy recommendation on Grupo La Comer. With a target price of 46.6 Mexican pesos and a 14% upside, we believe that the market has underappreciated the following three fundamental drivers. First, La Comer's intangible assets mode. Its premium formats and brand supports the highest profitability in Mexico's retail sector and provide room for a steady margin expansion. Second, La Comer's debt-free balance sheet enables discipline, self-funded expansion across its most premium formats. And third, Mexico's structural tailwinds, such as macro normalization and the growth of the wellness segment, creates an attractive opportunity that La Comer is uniquely positioned to capture. La Comer, as we know it today, was born in 2016 after their spin-off from Controladora Comercial Mexicana. In less than a decade, the company has rebuilt itself into Mexico's leading player, with 91 stores in the premium retail supermarket segment, with a geographical footprint focused on Mexico City, Valley of Mexico, and the center area. La Comer is not a mass market grocer. What truly defines the business is the customer it targets, AB, C+, which represents 21% of the population, but a 44% of the national income. La Comer is not trying to win the entire market. They are winning the right market. Omnichannel strategy remains central to La Comer's model, providing a seamless experience across physical and digital channels, with Monedero Naranja acting as a fidelization component, with 1 of every 2 pesos of revenue and a ticket 50% higher. Despite holding only 1.7% of the market share, what differentiates La Comer is not as simply as their product quality. La Comer operates a self-reinforcement cycle that the rest of the Mexican retail struggles to replicate.
As La Comer continues its differentiation strategy, ESG factors play a crucial role in maintaining operational efficiency. La Comer historically has made continuous improvements across its E, S, and G pillars. Environmentally, there are steady efforts in water management, energy use, and emissions per sales. Socially, the company has solid employee benefits and a robust supply chain, supporting overall stability. In terms of governance, La Comer upholds a strong code of ethics and a performance-linked executive compensation, reflecting internal structure oversight. Within the competitive landscape, La Comer performs slightly below the peer average, considering Soriana and Chedraui, with Walmart being the sector leader due to its investment capacity. However, the company still faces material areas for improvement, including clear long-term environmental targets, greater female representation in top positions, and concentrated ownership challenges. We will now move on to La Comer investment summary.
Now, let's talk about our investment thesis. We believe that given the industry bias or its scale, the market is overlooking La Comer's intangible assets mode. This company outperformed its most important peers in same-store sales and EBITDA margins, reflecting a strong pricing power reflected by its ABC Plus customer base. La Comer is the clear leader in both gross and EBITDA margins, and we believe it has room for expansion as the company shifts toward differentiated and higher value-added products.
Our second thesis centers in a self-financed growth that the market may be underappreciating. La Comer maintains a strong balance sheet since 2016 with a net cash position, including and excluding IFRS 16, that enables a disciplined and sustainable growth without using external capital that provides them a strategic flexibility. Now, we expect this expansion not to be diversified, but to be concentrated in the most premium formats, prioritizing Fresco and City Market that cater to high-income customers. By 2034, we expect La Comer to have 138 stores that will enhance for both margin accretion and brand equity. Finally, their omnichannel integration helps them to continue accelerating sales and profitability, with an e-commerce representing 10.4% of their sales and expected penetration of 50% in 2034, leading the Mexican retail digital penetration without using external capital through their app, La Comer en tu Casa. Our third thesis centers in structural tailwinds that the market may be underestimating. First, although Mexico macroeconomic growth has decelerated, with an expected GDP increase of 0.3% this year and a low recovery in 2026, La Comer continues outperforming the same-store sales growth. This is due to the exposure to high-income customers, whose spending power is not affected by this type of changes. Finally, the health and wellness market is expected to compound at a 4.0% annual growth, and this will be powered by three principal factors. First, the rising health consciousness, particularly post-pandemic. Second, the quality and prevalence driving purchasing among high-income customers. And third, the premium customer experience, a mode La Comer has established through their brands, their products, and their shopping experience.
Now, let's see how our investment thesis translates into our financials. La Comer continues to deliver a consistent growth trajectory built on its premium operating model. Revenue has expanded steadily, supported by strong same-store sales, rising customer traffic, and a higher average ticket driven by its premium formats. Looking ahead, our forecast shows sustained top-line momentum as the company accelerates its expansion into its premium formats. On the right, we can see steady margin expansion. Gross margin rises as the product mix shifts to our higher value-added products, while EBITDA and net margin is strengthened due to pricing power in the operating concept. Now, supermarkets compete on space, but La Comer competes on space productivity. When measured per square meter, La Comer's profitability reveals a company that extracts more economic value out of the same footprint. The company generates more revenue, EBITDA, EBIT, and net income out of every aisle and shelf, and accompanied with a same-store sales growth that has outperformed the average peers in almost all of the last 5 years. This model works because same-store productivity demonstrates high commercial traction. CapEx is funneled into its premium formats, which generate more from space, and it is supported by a product mix of higher value-added products. Now, if something could define improving margins translate directly into stronger returns over capital. As we can see, ROA, ROE, and ROIC all rise consistently across the forecasted horizon, and with an asset turnover that gradually increases, which reflects better store utilization and disciplined working capital management. Now, if something could define La Comer, is investing with intention, not with obligation. As we can see in their net debt to EBITDA multiple, La Comer is currently trading at a multiple of negative 0.2x, which is way below of those of its peers, which reflects their strong cash position and their low financial risk. And when comparing their debt to assets and debt to equity to the peer average, we can see another great advantage. And finally, another of La Comer's greatest strengths is their capital allocation. As we can see in our CapEx forecast, for 2025, we are considering 3 store openings due to management guidance, and for the following years, we're considering 5 store openings focused on their premium formats, adjusting each capital expenditure with the economic forecast for inflation to reflect real economic cost. And when analyzing earnings per share, we can see that these capital expenditures will continue generating increasing shareholder value in all of our 3 scenarios: base, bull, and bear.
And now, let's talk about the models that support our buy recommendation. Our valuation is anchored to a DCF, perpetual growth model, based on free cash flow to our firm, and supported by forward price to earnings and enterprise value EBITDA multiples. We assigned an 80% weight to our DCF, giving it superior ability to capture long-term cash generation potential, and 10% to each forward multiple to reflect current market expectations. The wonderful thing about here is that all methodologies converge within a tight range, and all of them support upside. Now, talking about our DCF, this model is anchored to a WACC that considers an incremental borrowing rate incorporated into the cost of debt, this accounting for the cost of leases under IFRS 16, and a company-specific risk premium incorporated into the cost of equity, accounting for La Comer's stock liquidity limitations. We expect 3 components to drive La Comer's future cash flows. First, same-store sales, accounting for ticket and foot traffic dynamics. Second, new store openings toward its most premium formats. And third, e-commerce growth. We perform a 25 scenario sensitivity matrix using WACC and terminal growth. The results? 23 out of 25 of them support upside. Now, talking about relative valuation, we can see that La Comer is currently trading at a discount relative to its most important peers in both forward price to earnings and enterprise value EBITDA multiples. When we translate this into equity value, the results show consistency with our DCF model. This reinforces a simple but powerful message. The market is not fairly valuing La Comer's fundamentals, and relative valuation confirms our buy rating. We also perform a full scenario framework, flexing the moat, SG&A pressure, and growth assumptions. The key insight here is, across narratives, the distribution remains asymmetrically skewed to the upside. Finally, to test the resilience of our valuation, we perform 100,000 Monte Carlo simulations, stressing key variables. The results speak for themselves, with almost 70% of simulations yielding above the current price and more than 50% of them above our own target price.
Despite our buy recommendation, we highlighted 2 major risks. First, labor risk. Rising payroll costs from the minimum wage hike and upcoming labor reforms may pressure margins. However, La Comer mitigates this through productivity systems and selective price adjustments. Second, geopolitical risk. Uncertainty around the 2026 USMCA review could increase tariffs and import costs, but La Comer's low foreign exposure and strong domestic supply limit this impact. Our buy recommendation stands reinforced by the 3 points we highlighted: strong margins, disciplined growth, and a powerful premiumization tailwind. At the end, you can go with the market or you can go with La Comer. We now open our appendix map for any questions you may have.
In a sector and in a company like La Comer, the economic variables are very important. So can you share with us much more information about the economics that you use for your cost stats, for your forecast? I mean, what about the GDP for the future? What about all this information? I think is very important.
Yeah, so as we mentioned before, La Comer is not a mass market. It's centered in high-income customers, and these are not affected by this type of macroeconomic environment because as we can see in the same-store sales that they have been having historically, they have a 10.4% and ANTAD has a 5.6%. And this is because they are not, well, the high-income customers are not affected by this type of macroeconomic environment, and we also expect that the economy will increase in 2026, and this is because of our target range that the inflation has expected and also the rate cutting cycle.
And we also, adding to my partner's answer, we also did for our revenue build-up, we were considering not only the new openings per format that each of La Comer's will continue having in the forecasted horizon, but also the average new store sales that each would have, considering the average square meters per store. And after that, the store maturity. The store maturity was in account to consider for cannibalization, which also allowed us to consider for these economic variables that could consider in the future.
Regarding store openings, the company has under-delivered versus promises and expectations, and you mentioned one of the risks being the capital deployment. So what's the sensitivity there and how would it change your evaluation?
So thank you for your question. My name is Jason. I will be answering it. So the answer here is that actually our assumptions are, in our view, conservative, considering that La Comer is currently expected to open 8 to 10 stores per year when we are considering only 5. So we are considering this conservative and under a better scenario with better conditions. Perfectly, the bullish scenario could materialize under these conditions. And we also, in our Monte Carlo analysis, one of the most important variables of this analysis was the store opening. So we actually account this in our Monte Carlo sensibility.
I wanted to ask you about the financial position because it is exposed, like you said, really flexible. But if they are not taking debt, is it really flexible? Do you think it could improve their valuation if they had taken debt?
We actually believe that the WAT could be optimized if the company incorporated debt, but the management has been really careful about this thing specifically because they are telling us in report that they won't issue debt. So our base case and our assumption was we cannot assume that La Comer will issue debt. But actually one of the great things here is that La Comer is performing self-financed and disciplined expansion because La Comer doesn't really care about being the biggest one. They care about being the most profitable one and the most efficient one. So we believe that this expansion and that our base case scenario is perfectly possible without issuing any debt.
In this new environment around the world, when many companies and sectors start to using the famous artificial intelligence, these companies doing something with this? Do you have some information about this one?
Sure. La Comer is implementing productivity systems in their operations. In their distribution centers, they operate them with technology. They also have store-level optimization that use automatization in order to have more efficiency and get more output per employee.
Could you tell me what are the main sources of the improvement you see on your estimates on ROIC and ROE?
So the main improvements that we're seeing in ROIC and ROE are mostly due to the two factors that we're considering. So first of all, in a revenue build-up, we can see that the revenue is increasing due to the new store openings, and as they mature, our ROE and ROIC always start to rise consistently. And also, we accounted for the growth that the already opened stores would have as they start reaching more maturity through same-store sales growth. And the same-store sales growth from La Comer is mainly driven due to two factors, which are the premium product mix that they offer, which ends up making for a higher average ticket, and also the foot traffic growth that the stores would continue increasing due to the maturity process that La Comer currently has.
Also, I want to complement the answer of my partner. Their self-reinforcement cycle is complementing their efficiency because it begins with a premium format and a brand assortment that offers La Comer that translates into a premium experience that high-income shoppers can actually feel, both in their in-store and online channels, and support their structural pricing power.
Why do you think La Comer has currently way lower returns than Walmex?
It is mostly due to the efficiency metrics. So when considering, as we were talking about, these metrics come directly from the increasing CapEx. And for example, something that characterizes the La Comer's model is their CapEx expenditure. So CapEx are are higher for their formats than other retailers. But the interesting part here is as they start reaching maturity, these stores continue generating more efficiency. As we can see in their profitability metrics per square meter are far superior than those of the average in the industry, which end up leading for this. And we believe that this is what the market will be seeing in the following years. This will be the advantages that they will be identifying and that which will lead to our upside.
I was wondering, in the multiple valuation, there is this upside to the average, which is composed mostly of Walmex. Why do you think that gap is going to close? It has always been cheaper than Walmex for several reasons.
Thank you. That is actually one of my favorite questions because we do believe that the competitive landscape of the retail sector is changing in ways that we didn't see earlier. We know about Tiendas 3B, a company that is currently eating the low-cost retail stores and segments. We believe that as 3B keep eating this market, the other price-sensitive players, such as Chedraui and Soriana, will probably start experiencing some issues in terms of growth, in terms of profitability, and La Comer, as is operating in the opposite side of the socioeconomic spectrum in Mexico, we believe that La Comer will maintain that position and that the market will start seeing La Comer for what it is, which is a better position with a company with a better position, better profitability and efficiency metrics.
I suppose that as many other companies, La Comer has huge plans for the future. What do you think is the most important plan or project for La Comer in the medium-term future?
Yeah. So first of all, we expect that the La Comer will continue expanding, especially in the Southwest, because as we mentioned before, La Comer is, the premium segment market is not well covered by the peers, and La Comer has a better expansion that they can start doing, and they started 1 month ago, the 5th of December, where they opened Tulum, that has a cost of 1.2 billions of pesos, and in this case we think that the Comer will continue this south expansion that will increase their same-store sales growth.
Do you think the La Comer capital structure is sufficient, and would you prefer the company to be more levered?
Well, we do think that incorporating debt into its capital structure will be favorable for La Comer, but first, this is very common for companies in the retail sector, and Walmex, for example, has a similar capital structure, but as we said in other question before, we believe that our base case scenario could be catalyzed with the conditions that La Comer is currently experiencing.
Thank you for your questions, Laura, Rafael, and Carlos.